Welcome to the Saigal Seatrade podcast. I'm Research Analyst Trisha and your host, and today we're diving deep into the tides that are shaping the global tanker and LPG shipping landscape. From VLCC rates in the Middle East to Brazilian ethanol policies shaping up Atlantic product flows, we've got it all. So, joining me today, we have someone who needs no introduction, shipping and commodity expert Mr. Sandesh Ghandat. So, welcome to the episode, Sandesh.
Thanks, Trisha. Thanks for inviting me once again. We have a lot to explore today.
So, Sandesh, let's start big with our very own VLCCs. The ex-MEG market, it opened quite soft. Even the West Africa is still under pressure. And even the ex-USG, it is still struggling to find the momentum. So, could you tell us why are VLCCs so fragile right now? And is this just seasonal softness or something deeper?
Well, that's a powerful place to begin, Trisha. Let's unpack this. Starting with the MEG, that is Middle East Gulf, we are seeing a textbook case of oversupply meeting underwhelming demand. And then we have a relate activity essentially where, the charters putting tonnage back into the market. And you know what? It has created a glut, particularly of, compromised units or the compromised VLCCs. So these are older, sometimes less efficient vessels or those with, partial approvals, and they are distorting the rate structure. So let's take an example of our benchmark routes TD2 and TD3C. Here rates slide to world scale 45.33 and 44.66, which kind of reflects a weekly drop of 0.5 and 0.87 points, which is very marginal. And that's not just a paper damage. The real hit is on TCs. So it was down by 3.24% and 5.21% respectively. Now switch over to the West Africa, that is again TD15 benchmark. It's a bit of paradox. We saw a 1.6 point increase to world scale 15.13 with a 4.54 uptick in TCs. But that's mostly noise because fixture volumes, they were thin and kind of a mood remains subdued. Now you will ask the outlook. I will say that it's still murky unless, the Chinese demand, it kind of ramps up or, we see a spike in the Indian PSU's interest. Talking about the Indian PSU's interest, we only saw two VLCC cargoes quoted by the PSUs. One at, 3.65 million lump sum basis, West Africa to West Coast India. And then over in the Gulf or the US Gulf, we are seeing the impact of low eastbound demand and almost no long haul pull. And that's why TD22, the benchmark rate, it dropped around 7.22% in terms of TC. And the rate was landing at around 6.64 million lump sum basis. In addition to that, we saw a few transatlantic voyages, that helped kind of stabilize rate ideas, but it didn't ignite any optimism. So to your question, is this a seasonal? Yes, I will say, but it's partially. But I would argue there is a still structural undertone, and here we saw muted refinery margins, then Russian crude, it kind of a rerouting, and the macro hesitancy from the refiners are collectively stalling the VLCC dynamism.
Well, Sandesh, now let's zoom in into the Suezmax and the Aframax segments now. So, we are seeing resilience in ex-WAF Suezmax rates even as Aframax routes like TD8 and TD14 weaken. So, could you tell us what's exactly is driving this divergence?
Well, Trisha, great observation, and it's one that tells a lot about the market psychology, because in the Suezmax market, ex-MEG, that is Middle East Gulf, it stayed remarkably steady. And despite a heavy tonnage list and VLCC competition, off-market fixing just picked up. We saw the benchmark TD6, it rose by around 7.05 points to world scale 103.94 with TCs or the earnings. It's also jumped by close to 18%. Now in the West Africa, Suezmax story is kind of a stronger. We have seen the 20 another benchmark, it climbed by 9.56 point to world scale 86.39 and TC almost up by 21%. So what's behind this? It's the classic squeeze. And what is that, you may ask? So it's a prompt availability that dried up and the transatlantic demand stayed firm. Now also the Aframax sector itself is a lending indirect support, and then the traders pushing up into the larger sizes when smaller units lack availability. Now compare that to the Aframax market and the contrast is kind of a striking. So here we have XMEG TD8 benchmark, it dropped by 4.78 points to world scale 125.36, and the TC was also down by just over the 7%. And then the ex Southeast Asia market TD14, it failed by 2.12 points to world scale 107.13 with a 5.13% deep in TC. So Suezmax are simply more attractive right now due to a better fuel economics and kind of charter's preference for higher capacity units. So in short, Suezmax are kind of a flexing due to a smart fleet positioning, and then we have a stronger transatlantic pulls, while Aframaxes, they are kind of waiting for some catalyst, maybe a short haul crude push or the fuel oil rebound to shift momentum.
Well, now that we've talked about the crude market, let's dive into the product tanker space. We see the LR1s are holding strong, the LR2s are booming, and even the MRs are moving east again. So, give us the lay of the sea here, Sandesh. Could you tell us what's working, what's tightening, and majorly who's winning?
Absolutely, Trisha. This is where things get kind of exciting. Now, let me start with the LR2 segment. We have seen the TC1, it surged by world scale 18.34 to world scale 147.78. And you know what? It translates into massive over $6,000 per day increase in TC, and it is up by 15.36% to $33,183 per day. Tight tonnage and uncovered cargoes for mid-August and bullish owners are the recipe here. That's about the LR2, but you may ask what happened with the LR1. So the LR1s weren't quite either. We have seen the TC5 benchmark, it rose by world scale 5.63 to world scale 155.63, and then again the TC or the earnings, it rose by more than $1,000, and it was just over to $23,500 per day. And then if we calculate the spread among LR2 and LR1, they were still holding tight, and the spread was just world scale 7.5 between LR1s and LR2s. And you know what? It is signaling that demand remains quite elevated across the both sizes. Then on the MR side, things get interesting with the repositioning trends. We have seen the TC12 kind of a climbed up by world scale 4 to world scale 173.13, and then the TC70 again jumped by world scale 16.43 to world scale 243.57. So you may ask what is the real kicker? So the MRTCs on the TC17 benchmark, it hit over more than $25,000 per day, or you can say that just little below than $26,000 per day. But here is the twist. We have got 39 MRs ballasting back to the east of Suez, and 24 are already on the subjects or kind of a tied to COS. So that tells you the sentiment is bullish. The tonnage list is tightening, and with 0.25 million metric tons of clean cargo scheduled to be lifted next week, there is a real momentum building.
Well, here is an interesting question for you, Sandesh. Let's turn to the geopolitical bombshell. Brazil's move to E30 gasoline blending. And could you tell us how is that policy shift reshaping the trade flows? And most importantly, can Indian refiners really step into this vacuum left by the US and Russia?
Well, I will not call it as a geopolitical bombshell, but you know what? It's a policy shift, and this one is big. So let me just give you a brief overview, because the Brazil, it kind of going to be implementing E30 blending effective from the 1st August. And that's a 30% ethanol mandate, up from 27.5%. And it catapults Brazil's ahead of even the US in the ethanol adoption. So for context, the US has mostly stuck to the E10 with limited to E18 or E85 availability, and then the Europe is kind of a largely E5 to E10. So that is how the contrasting it is in terms of gasoline adaptability with respect to ethanol. So you may ask, 2.5% will that really impact? So yes, the real impact will be there. We expect that Brazilian gasoline imports will subject to drop in the coming months, and that's a bearish for US Gulf refiners and to some extent for Russian suppliers, who already captured that market share in 2024, but are now kind of facing tightened Western sanctions and enforcement. And you know what? This is where the Indian refiners, specifically those on the West Coast, can step in. So even though we think that the imports will drop, but there will be still opportunity present for Indian refiners, and they are kind of a well placed logistically and competitively priced. So if they seize this moment, LR2 tanker earnings could rise up by 5.5 to 6%, and even the fleet employment kind of a rise by 3 to 4% for the vessels. Those are going away from the India, or those are kind of ex West Coast India loadings. So strategically, this could be India's foothold into Atlantic Basin product flows. And imagine an Indian owned LR tonnage regularly calling Latin America. So that's a diversification masterstroke.
So, to close things off, Sandesh, let's touch on the LPG tankers. So, the east of Suez is seeing some optimism, and the west, on the other hand, is mixed but recovering. So, could you tell us what's the big picture here?
So definitely, you know what? LPG has its own flavor last week, Trisha. So in the east of Suez, freight for AG Chiba, it kind of held in the mid 80s per metric ton with 11 fixtures reported, and most of them were fixed around second decade August. So tight tonnage and then the monsoon delays are keeping list lean. Indian demand is expected to kick in soon, which could push rates even higher. Now in the West, it's kind of a different story because fixing was kind of hovering in the mid to highs 130s per metric ton for first decade of September. But tonnage is still long. However, delayed relates from the east and vessel repositioning plans are kind of a helping tighten first half of September. So if that trend holds, west of Suez could stage a short-term recovery. Now, owners, they are kind of a watching closely, Trisha, and some may shift, east for premiums. The sentiment, it looks cautiously optimistic, and especially as charters try to lock in before rates rebound.
Well, that was indeed an incredibly deep dive, Sandesh. From VLCC volatility to ethanol geopolitics, this episode had it all. So, thank you for sharing your insights with our listeners.
Well, thank you, Trisha. Thanks for inviting me once again.
And to all our listeners, thank you so much for tuning in. Do not forget to share and subscribe to the Saigal Seatrade podcast. Until next time, navigate safely and stay informed.